Welcome back to the Deep Dive. Today, we are strapping in for what might just be the single biggest seismic shift happening in finance right now. We're talking about the institutional embrace of digital assets. Specifically, the crypto ETF revolution.
It feels like a revolution, doesn't it? Things are moving so fast.
They really are. I mean, if you've been watching the news flow, particularly out of D.C. and Wall Street, the sheer volume of ETF applications hitting the SEC. It's just staggering. It feels honestly almost aggressive, an unprecedented flood. And it's not just Bitcoin anymore, is it? We saw the spot Bitcoin ETFs go live, which was huge in itself. But now the pipeline is jammed with proposals for Ethereum, for Solana, even these thematic baskets scooping up indexes of altcoins or layer one projects.
Yeah, the scope has broadened dramatically. It's not just digital gold anymore.
Exactly. So our mission today, for you listening, is to really cut through all that noise. We need to understand why these ETFs are constantly being called Wall Street's main entry ramp into crypto. And maybe more importantly, what does this mean for the trillions in potential institutional money that's supposedly sitting on the sidelines? Money just waiting, apparently, for a secure, regulated way to get exposure without, massive compliance headaches.
Well, I'd say it's maybe more than just a ramp at this point. It feels more like a brand new multi-lane highway suddenly opened up. And the ribbon-cutting ceremony, the immediate catalyst for all this, it was absolutely the SEC's approval of those first spot Bitcoin ETFs back in early 2024. That single decision wasn't just big for Bitcoin itself. It fundamentally cracked the door open for the entire asset class.
Crack the door is maybe an understatement. Blew it off its hinges.
Maybe. Because the significance, you really can't overstate it. The biggest players, the established financial giants, they didn't just watch, they jumped in immediately. We're talking firms like BlackRock, Fidelity, Titans, right? With trillions in AUM.
Yeah, the household name.
Exactly. Their involvement, it wasn't just about legitimizing Bitcoin as an asset you could hold. It legitimized crypto, broadly speaking, as a regulated, viable investment product. Something that could actually fit within the existing traditional financial plumbing. And BlackRock, I mean, their track record on getting ETFs approved is practically perfect. That alone sent a massive signal to the rest of Wall Street. Okay, game on. The time is now.
Right. If BlackRock's in, everyone else feels safer following.
Precisely. And so now the hunt is absolutely on. Every major firm is laser focused on capturing what they see as the next wave of products. The filings are coming thick and fast, super competitive. They're specifically targeting, as you said, ETH spot ETFs. That's the big one everyone's watching. But also, Solana ETFs are being talked about seriously. And these more complex, diversified crypto baskets, it's like the moment that first Bitcoin door creaked open, everyone just sprinted towards the next potential doors down the hall. There's this sense that regulatory approval for one major asset sets a really powerful precedent for others.
Okay, so let's unpack that a bit. Get specific. If these ETFs are this critical infrastructure bridge, this highway, as you put it, how exactly do they change the game for different types of investors? Because, the needs are so different, right? A young retail investor using a mobile app has completely different constraints, different legal worries than, say, a giant state pension fund managing billions.
That's absolutely the crucial distinction we have to make. The benefits, they land very differently depending on who you are in the investment world.
Okay, so let's start with maybe the most relatable group for many listeners, the everyday retail investor, the person saving for retirement, maybe putting money aside for their kids' college. For them, what does an ETF fundamentally change? Is it just about making it easier to click buy?
Well, ease of use is a huge part of it, definitely. But it's more about access and, crucially, trusted access and security. Think about it. Before these ETFs, getting real direct exposure to Bitcoin or Ether, it was kind of involved, wasn't it? You had to figure out crypto exchanges, maybe worry about their solvency or where they were based. You had to deal with private keys, wallets, maybe cold storage.
Yeah, the whole not your keys, not your coins mantra, which is powerful, but also, frankly, intimidating for a lot of people.
Exactly. It introduces technical hurdles and, let's be honest, risks of user error. Losing a seed phrase, sending coins to the wrong address. It happens. The ETF just obliterates all of that complexity for the end user. You don't worry about seed phrases. You don't choose a custodian. You can now get that crypto exposure using the existing trusted financial plumbing you already know. Your 401k, your IRA, your standard brokerage account.
So it slots right into their existing financial life.
Perfectly. It integrates crypto into that familiar world of financial planning, tax-advantaged accounts. It becomes by far the easiest and perceived safest path for the average person who just wants some exposure, wants to click buy on their phone app within a structure they already trust and understand. It drastically cuts down the risk of individual mistakes or, picking an exchange that goes bust.
Okay, that makes a ton of sense. It reduces the friction, removes the scary tech part for the retail buyer. But I think we both agree, and the sources really hammer this home, the real game changer, the reason we're talking trillions, is the institutional side.
Yeah.
For the big money, you said it's not just access, it's about fiduciary duty, compliance, mandates. Can you expand on that? Is it really that simple? I mean, haven't some large institutions already built out ways to hold crypto using specialized custodians like Coinbase Prime? Do they really need the ETF wrapper?
That's a great question, a really sharp point. And the answer is overwhelmingly yes. They absolutely do need that ETF wrapper, even if some have bespoke solutions. For those massive institutional players, we're talking pension funds, endowments, insurance companies, sovereign wealth funds, the benefits pivot around two critical things: regulatory clarity and managing legal liability. These entities operate under incredibly strict fiduciary duties.
Right. They have a legal obligation to protect their clients' or beneficiaries' money.
Exactly. A legal and ethical obligation to manage those assets prudently in the client's best interest, minimizing unnecessary risk. They simply cannot use some offshore, unregulated crypto exchange. The career risk, the headline risk, the legal risk is immense. And even self-custody, while technically possible, is fraught with operational risk at that scale. Imagine explaining to pensioners that you lost $1 billion because someone mishandled a private key. It's unthinkable.
So the liability is just too high for them to handle directly.
Catastrophic. What the ETF structure provides is this neat, standardized, packaged investment vehicle. Crucially, it's stamped with the SEC's approval, or at least operates within their regulated framework. It fits perfectly into their existing highly audited, highly regulated risk management processes. And the key element, as you hinted at, is custody. With the ETF, the institutions themselves don't have to worry about the nightmare of securing the private keys for the underlying Bitcoin or Ether. The ETF issuer, the BlackRocks, the Fidelities, takes on that massive burden, and they do it using professional, insured, highly regulated third-party custodians.
So they essentially outsource the trickiest, riskiest part, the actual holding of the coins, to a specialist regulated entity via the ETF structure.
Precisely. That regulatory clarity combined with solving the custody nightmare is the essential green light. That's what allows the billions and potentially trillions to finally flow in. It satisfies their duty of care, their compliance checklists.
Okay, so it's the compliance and custody solution neatly bundled. Got it. Now let's look at the third group you mentioned. The professional traders, the quants, the arbitrage desk. You mentioned arbitrage opportunities. Can you break down how that works mechanically? How does an ETF trading on the NASDAQ create opportunities linked to, say, Bitcoin trading on Coinbase?
Yeah, this is where it gets really interesting from a market structure perspective. The creation of these massive, liquid, regulated ETFs forces a very strong, very real-time linkage between the traditional financial markets, TradFi as people call it, and the underlying, often more fragmented, on-chain crypto markets.
How does that link work?
It all revolves around the ETF's net asset value, the NAV. The NAV is basically the real-time market value of all the actual Bitcoin or Ethereum that the fund holds, divided by the number of ETF shares out there. Now, the ETF shares themselves, they trade like any stock on the NYSE or NASDAQ through the day, and sometimes tiny discrepancies can open up between the ETF's trading price and its underlying NAV.
Okay, so the shares might drift slightly cheaper or slightly more expensive than the value of the crypto they represent.
Exactly, for brief moments. And that's where specialized trading firms, known as authorized participants or APs, jump in. They have agreements with the ETF issuer. Their job is to perform arbitrage to close that gap. If the ETF shares are trading, say, slightly cheaper than the NAV, a discount, the AP can buy up those cheaper ETF shares on the stock exchange. Simultaneously, they can redeem those shares with the ETF issuer, receiving the equivalent amount of actual Bitcoin. They then immediately sell that Bitcoin on a crypto exchange at the slightly higher price, pocketing a small, risk-free profit.
And if the ETF trades higher than the NAV?
They do the reverse. They buy the actual Bitcoin on a crypto exchange, deliver that Bitcoin to the ETF issuer in exchange for newly created ETF shares called creation units, and then sell those shares on the stock market at the slightly higher price. This constant buying and selling pressure from the APs, driven by these tiny price differences, is what keeps the ETF's market price incredibly tightly tethered to the real-time value of the underlying crypto.
Okay, and how fast does this happen? And importantly, does this arbitrage activity actually increase liquidity for the underlying Bitcoin or Ether itself? Or is it just about keeping the ETF price in line?
It happens incredibly fast. We're talking milliseconds, driven by sophisticated algorithms and high-frequency trading infrastructure. The primary goal is price alignment for the ETF, but the direct consequence is that it fundamentally increases liquidity and depth across the entire ecosystem. Think about it. When lots of people are buying the ETF, the APs need to create more shares. To do that, they have to go out and buy the underlying Bitcoin or Ether on the open market. That's real buy pressure.
Right. Demand for the ETF translates into demand for the actual coin.
Exactly. And conversely, if there's heavy selling of the ETF, APs redeem shares, receive the underlying crypto, and sell that crypto onto the market. So that's real sell pressure. The ETF effectively acts as this massive plumbing system, constantly connecting Wall Street's order flow directly to the crypto exchanges. It tightens the connection, ensures price signals transmit efficiently between the two worlds, and it means huge blocks of institutional capital can flow into or out of the ETF structure with relatively minimal price impact on the ETF itself, because the underlying crypto market absorbs that flow through the AP's actions.
Wow. Okay, so the ETFs aren't just passive containers. They are an active infrastructure layer, constantly interacting with and linking Wall Street and the crypto markets, enforcing that price cohesion.
That's a great way to put it, an active infrastructure layer.
Okay, let's shift gears slightly and look ahead. Because if this door, this highway, stays open, institutional interests surely won't just stop at Bitcoin, right?
Yeah.
We need to talk about that ripple effect, the next frontier. Where does that capital flow next? Which specific assets seem poised to benefit the most?
Yeah, the immediate, absolutely critical focus right now is Ethereum, no question. While Bitcoin has solidified its narrative as digital gold, a store of value, Ethereum is something different. It's the global settlement layer, right? The decentralized world computer that underpins so much of DeFi, NFTs, stablecoins, the whole Web3 infrastructure.
The foundational layer for applications.
Precisely. So if the SEC gives the green light to ETH spot ETFs, that approval is widely expected to just dramatically supercharge Ethereum's price, yes, but also its adoption curve. Because it's not just validating ETH as an asset, it's implicitly validating Ethereum as a critical piece of next-generation financial infrastructure.
And there's already some regulatory precedent for Ether, isn't there? More so than for other altcoins?
There is. We already saw the approval of Ethereum futures ETFs back in 2023. That was a really significant step. It signaled that regulators, particularly the CFTC, which oversees futures, were growing comfortable with ETH, especially after its transition to proof of stake. They classified ETH futures as commodity futures. So that set a bit of a technical and regulatory stage. And now these major filings for spot ETH products are demanding the SEC's attention. And approval wouldn't just be about ETH's price. It would send ripples through the entire smart contract ecosystem. It's a recognition that the layer where decentralized finance happens is robust, secure, and crucially investable for trillions in traditional capital.
Okay, so ETH is the clear #2 priority. If that happens, then we start talking about expansion beyond the big two. And that's where things get really interesting, potentially opening the floodgates for the wider Web3 space. The sources you looked at specifically call out Solana and other Layer 1 protocols, the infrastructure builders.
Yeah, and this raises a really important, maybe longer-term question about the future shape of crypto infrastructure. What happens if this ETF trend moves beyond just Bitcoin and Ethereum? I mean, imagine if the SEC, down the line, gives the nod to a Solana ETF, or maybe, a Cardano ETF or Avalanche, or one of the other major layer ones. That kind of approval sends a profound signal of institutional confidence. It goes way beyond just price speculation on these tokens.
Also, what's the deeper validation?
It validates these next-generation blockchain networks, not just as, exciting tech experiments or high beta bets. It validates them as legitimate, potentially scalable, and acceptably secure platforms worthy of being included in regulated financial products accessible to the biggest money managers in the world. For a chain like Solana, for example, a successful ETF launch would be a massive endorsement of its high-throughput architecture, its low transaction fees, its growing developer community. It says, okay, this isn't just a niche thing anymore. This is potentially core infrastructure for the future, and it's investable by the most conservative, risk-averse institutions. That's a huge step in cementing the long-term viability of these L1s.
Right, it elevates them from altcoin status to potentially foundational tech in the eyes of TradFi.
Exactly. And then the ultimate expansion, the one that really gets the broader crypto community excited, is this idea of crypto basket ETFs.
Moving beyond single assets entirely into theme strategies.
Precisely. A crypto basket ETF wouldn't just hold BTC or ETH. It might track a custom index. Imagine, say, a DeFi blue chip index holding the governance tokens of the largest decentralized exchanges and lending protocols.
Or maybe a Layer 1 competitors index tracking the top 5 L1s excluding Bitcoin and Ethereum.
Exactly. The creation of those kinds of diversified products, if they get approved, would mean that a much wider spectrum of crypto projects, even ones with smaller market caps currently, could suddenly gain exposure to that enormous pool of TradFi liquidity.
So projects that are maybe struggling for visibility or stable funding could get a huge boost just by being included in an index that an ETF tracks.
It could be a complete game changer for them. It could open up significant new sources of stable, long-term capital flowing into the broader Web3 space. Think about projects that currently have low trading volume or are super vulnerable to volatile market swings being included in an institutional-grade basket ETF. That brings potentially sticky long-term investment. It enhances stability, it boosts credibility, and importantly, it forces traditional financial analysts to actually do the work, to dive deep into the weeds of these smaller ecosystems, understand the tokenomics, the tech, the governance, to justify including those tokens in their index products. It forces education and due diligence on a massive scale.
Okay, the potential ripple effect seems enormous, moving from BTC to ETH to L1s to entire baskets. But to really gauge the scale of this potential impact, we probably need to ground ourselves a bit. Look at what history tells us. Look at the precedents. Because this ETF boom isn't happening in a vacuum, right? It's built on some very clear legal wins and some pretty undeniable market demand that we've already seen play out.
Absolutely. Context is everything here.
So let's start with the clearest, most recent data point. The one that, frankly, shocked a lot of analysts with its speed and size. The success of the Bitcoin spot ETFs right out of the gate in early 2024. This just proved, definitively, that the demand wasn't theoretical. It was very, very real.
Oh, it proved the pent-up demand was absolutely immense. It almost instantly dwarfed most historical ETF launches in other asset classes. Within just the first few months of these various Bitcoin spot ETFs launching, the collective group saw well over $10 billion in net inflows. $10 billion.
Which is just a staggering number for a new product category.
It really is. And to put that in perspective, our sources note it far surpassed the initial inflows into the very first gold ETF over a comparable period back in the early 2000s. It signals potentially a much faster rate of adoption for crypto as a mainstream asset compared to how traditional commodities got integrated. And specific products like BlackRock's IBIT ETF, it reached milestones like $1 billion in assets under management faster than almost any ETF launch in history, period, full stop. It went from zero to being treated as a core holding, a mainstream asset class, almost overnight. That sheer scale of capital flow just confirmed it. Institutions, advisors, even retail, they were just waiting on the sidelines for that regulated, easy-to-access green light.
And that green light, that approval, it arguably only happened because of a major legal battle that essentially forced the SEC's hand, right? We have to talk about Grayscale's victory.
Yeah, that's absolutely right. The sources correctly highlight the Grayscale lawsuit as a pivotal moment. Grayscale runs the massive existing Grayscale Bitcoin Trust, ticker GBTC. It held billions in Bitcoin, but traded as a closed-end fund, often at a significant discount or premium to its actual Bitcoin holdings. Grayscale wanted to convert GBTC into a proper spot ETF, which would allow those arbitrage mechanisms we discuss to keep the price tightly pegged to Bitcoin's value. The SEC repeatedly denied this conversion.
So Grayscale sued them.
They did. And crucially, the court sided with Grayscale. The ruling was quite pointed, stating the SEC's denial was arbitrary and capricious.
Strong words from the court. Why arbitrary?
Because the SEC had already approved Bitcoin futures ETFs. These futures contracts are priced based on the same underlying spot Bitcoin market, often using the same pricing indexes and surveillance mechanisms that a spot ETF would use. So the court basically said, look, if you're comfortable with an ETF based on Bitcoin futures, you can't logically argue that the underlying spot market itself is inherently too manipulated or unsafe for a spot ETF using the same data. The reasoning was inconsistent. That legal pressure, that binding court ruling, was really the key catalyst. It heavily influenced the SEC's subsequent approval of all the other spot ETF applications. It established a clear legal roadmap, a precedent, that makes it much harder for them to deny similar crypto products without very strong new arguments.
Okay, so the Grayscale win provided the legal blueprint. But if we really want to grasp the potential adoption curve for crypto ETFs, the clearest historical parallel, the roadmap, seems to come from the world of commodities, specifically gold.
It absolutely does. The comparison to the launch and rise of gold ETFs is incredibly instructive. The World Gold Council study, referenced in our materials, acts as a perfect template here. Think about investing in gold before the first big gold ETF, GLD, launched around 2004. What were your options?
Buy physical bars or coins, which means storage hassles, insurance, security worries, maybe assay costs if you sell.
Exactly. Cumbersome. Or you could trade gold futures contracts, which is highly technical, involves leverage margin calls. Not suitable for most investors. It was relatively inaccessible, illiquid for the average person or even many institutions. The introduction of the gold ETF completely transformed that. Suddenly, gold went from being this complicated physical commodity or a niche futures product into a mainstream, highly liquid, easily accessible investment. Anyone with a standard brokerage account could buy or sell exposure to gold in seconds, just like a stock. The ETF structure provided the liquidity, it stripped away the complexity, and it offered that essential regulatory comfort and ease of custody. We're seeing the exact same dynamic play out right now with Bitcoin and potentially other cryptos, only as that inflow data suggests, perhaps at a significantly accelerated pace.
So the historical lesson is crystal clear. ETFs democratize access, they bring in waves of new capital from investors previously shut out, and they solidify an asset status as a core investable financial instrument.
Precisely. And if crypto genuinely follows that gold ETF trajectory, then despite the huge inflows we've already seen, we are likely only in the very early innings of its mainstream financial integration. And speaking of mainstream integration, there's one more interesting case study our sources brought up: the corporate treasury strategy, pioneered by MicroStrategy.
Ah, yes. Michael Saylor's company. They took a really aggressive approach, didn't they? Using their corporate balance sheet to acquire massive amounts of Bitcoin.
Extremely aggressive. They essentially transformed MicroStrategy, a software company, into something of a leveraged Bitcoin holding company, a proxy for Bitcoin exposure trading on the stock market.
But what was the key financial result that makes this relevant to the ETF discussion? Did it work as a strategy?
Well, it created what analysts started calling the MSTR premium. For long stretches, MicroStrategy's stock, MSTR, traded at a significant premium compared to the actual market value of the Bitcoin it held on its balance sheet.
Why would people pay more for the stock than the underlying Bitcoin was worth?
Because before the spot ETFs were approved, buying MSTR stock was one of the easiest ways for public market investors, especially institutions that couldn't directly hold crypto yet, to get highly liquid, easily tradable exposure to Bitcoin within a traditional equity structure. It often acted like a higher beta, or perhaps more tax-efficient for some, version of Bitcoin exposure. What this did was validate in the eyes of the public markets that holding large amounts of crypto on a corporate balance sheet could be seen as a significant value driver, not just a speculative risk. It showed that aggressive crypto adoption could actually pump up your stock valuation. It provided yet another TradFi-friendly bridge to Bitcoin exposure, serving as a kind of proof of concept for corporate crypto integration before the ETFs arrived.
That's fascinating context. Okay, so we have the explosive ETF launch data, the grayscale legal win, the gold ETF roadmap, and the MicroStrategy corporate experiment, all pointing towards massive potential. Now, for you, the listener, trying to navigate this, trying to stay ahead, we need to talk metrics. If potentially trillions are going to flow through these ETF products, what are the key indicators we should all be watching? How do we track the market's pulse here? Our sources give us a really useful checklist of analysis ideas.
Yeah, these metrics become absolutely essential for anyone trying to understand the health, direction, and implications of this market shift post-ETF approvals. First, and maybe most obviously, you have to compare the ETF inflows versus outflows for the different assets. Right now, it's all about BTC ETFs, but soon, we hope, we'll be watching potential ETH ETFs too. If and when those launch, comparing the speed and volume of inflows into ETH versus BTC ETFs will be incredibly telling.
What would that comparison indicate?
It could signal which asset class institutions are prioritizing. Are they treating ETH primarily as a growth asset, maybe part of a tech allocation? Or is it also seen as a store of value competitor to Bitcoin? The flow data will give us clues about institutional portfolio construction intentions.
Okay, flows are key. Second metric, monitoring price action specifically around SEC approval deadlines. This seems less about long-term trends and more about short-term volatility and sentiment.
Absolutely. This is crucial for traders, but also just for understanding market psychology. We saw how Bitcoin jumped in January 2024, right when the approval news finally dropped. The sources correctly point out that volatility charts tend to spike violently around these SEC deadlines. Any significant news, even a rumor of a delay or a hint of a possible approval or an expected denial, can drive massive short-term price swings. Why? Because sophisticated traders are aggressively trying to position themselves, trying to front-run the anticipated institutional flows that would follow an approval. These dates, these regulatory milestones, are now absolutely critical market-moving events.
Got it. Watch the deadlines for fireworks. Third, let's circle back to that gold analogy. You suggested tracking the overall assets under management, the AUM of all crypto ETFs combined, versus the total AUM in gold ETFs. This feels like the big picture macro comparison.
This is how we track the potential generational shift in asset allocation. If the collective AUM held in crypto ETFs, BTC, ETH, maybe others, someday starts rapidly climbing and, say, approaches or even eventually surpasses the total AUM held globally in gold ETFs, well, that signals a massive wealth rotation is underway. It would suggest that digital assets are seriously challenging, or even overtaking gold as the preferred non-sovereign store of value or portfolio diversifier in the eyes of global investors. This metric gives us that grand-scale comparison over years, even decades.
Wow, okay. Fourth metric. Analyzing the correlation. Specifically, the correlation between crypto asset prices, like BTC and ETH, and traditional equity indexes, like the NASDAQ or the S&P 500. This gets right to the heart of that Wall Street integration theme, doesn't it? And maybe the potential loss of diversification benefits.
Exactly. We need to constantly measure how tightly Bitcoin and Ethereum prices move in tandem with major stock market indexes after these ETFs bring in so much institutional capital. If that correlation tightens significantly, and some early data suggests it already is, what does that mean? It means crypto is behaving less like a unique, uncorrelated, decentralized asset floating in its own ecosystem, and more like, perhaps, a high-beta tech stock, sensitive to the same macroeconomic factors, interest rate moves, and risk-off sentiment that drives the NASDAQ. Now, tighter correlation signals deeper integration and acceptance by mainstream finance, which is good in one sense, but critically, it also erodes the diversification benefit that was one of crypto's major selling points for traditional portfolio managers. If it just moves with tech stocks, it's less useful as a hedge.
That's a really crucial trade-off.
Yeah.
Okay, fifth metric. Monitoring on-chain flows versus ETF demand. This sounds important for understanding the fundamental health of the underlying blockchain networks themselves, not just the ETF price.
This is super important, maybe slightly more nuanced. We need to measure if these massive inflows into regulated ETFs are actually translating into, or perhaps even detracting from, direct usage of the blockchain. Are people still making on-chain transactions? Are they using decentralized exchanges? Are they participating in staking or DeFi protocols? Or is activity stagnating even as the ETF price goes up? If billions flow into the ETFs but actual on-chain activity flatlines or declines, it might suggest people are just opting for that synthetic paper exposure in their brokerage account instead of actually using the underlying technology. This gets directly at that paper Bitcoin risk we need to discuss more, where the value gets locked up in a centralized wrapper, potentially starving the decentralized network of active participation and utility.
Right, a potential decoupling of price from fundamental network activity. Very interesting. And finally, the sources suggest tracking volatility not just around the final decision deadlines, but around any ETF filing news.
Yeah, the market has become incredibly sensitive to regulatory news flow. Any new filing by a major player like BlackRock for, say, a Solana ETF, that immediately moves the price. Any perceived hint or comment from the SEC chair about crypto classification, market reacts instantly. These regulatory catalysts, not just tech upgrades or halvings or protocol developments, are now primary drivers of short-term volatility. Understanding that news flow, understanding that the regulators hold so much sway over market sentiment now, is absolutely key to navigating this increasingly integrated market.
Okay, that's a fantastic toolkit of metrics for listeners to keep an eye on. So we've spent a lot of time on the incredible bullish potential, liquidity, the validation, the access, the historical parallels. But every major advance, every big shift like this comes with trade-offs. It comes with risks. What are the potential downsides here? What are the regulatory roadblocks still in place? And what about the deeper, maybe more philosophical or even existential conflicts arising from this institutional embrace?
Yeah, we absolutely have to address the risks and the inherent tensions here. The first risk is the most immediate and tactical one. Continued regulatory roadblocks, especially for anything beyond Bitcoin. The SEC, let's face it, has been historically very cautious, even skeptical about crypto. While the Bitcoin spot ETFs got through, largely due to that grayscale court loss, The SEC could very well still delay or potentially outright deny ETFs for assets like Ethereum or Solana.
On what grounds could they deny ETH or SOL if BTC is approved?
They could try to argue different regulatory classifications. Is ETH still potentially a security in their eyes, unlike Bitcoin, which seems clearly viewed as a commodity now? That debate is still simmering. Or they might raise persistent concerns about market manipulation or insufficient surveillance sharing agreements for the underlying markets of ETH or SOL, arguing they are less liquid or mature than the Bitcoin market. They still have avenues to push back.
And as we just discussed with the metrics, this ongoing regulatory uncertainty itself becomes a major source of market friction and volatility, right? Driven purely by DC rumors and deadlines.
Absolutely. Those SEC decision dates, whether they result in an approval, a delay, or denial, become these focal points for massive volatility spikes. They create intense short-term price pressure, both up and down. Investors just have to anticipate this kind of choppy, news-driven market action now. It's a significant change from the earlier days of crypto, which were driven more purely by tech developments, adoption cycles, or macroeconomic wins. Regulatory risk is now front and center.
Okay, so regulatory hurdles remain a key risk. Beyond the regulators, though, there's a deeper, more philosophical risk that revolves around the potential dilution of the original crypto ethos. Our sources raise two really interesting related concerns here. First, the dilution of actual on-chain activity, and second, this potentially dangerous concept of paper Bitcoin. Can you unpack those?
Yeah, this gets to the core of the tension. The dilution risk is very real and kind of subtle. As ETFs become so incredibly easy, convenient, and importantly, safe feeling to purchase within the traditional system, many people, maybe even most people eventually, might logically choose that regulated ETF product instead of going through the hassle of buying and holding actual crypto themselves. Why bother with a hardware wallet, backing up seed phrases, paying on-chain transaction fees, if you can just get the same price exposure with one click in your IRA or your Robinhood account?
It's the path of least resistance.
Exactly. But if that becomes the dominant way people hold crypto exposure, it could lead to a significant reduction in direct on-chain activity. Fewer people actually using the network, sending transactions, interacting with smart contracts, participating in governance.
And that connects directly to the paper Bitcoin idea.
It does. High demand for ETFs creates enormous amounts of synthetic or paper exposure. Investors own shares in a regulated fund that represents the underlying asset that tracks its price. But they don't hold the actual keys. They aren't directly contributing to the security or the usage of the underlying blockchain technology. They're essentially outsourcing their stake to Wall Street. The risk is that the vast majority of the market value associated with Bitcoin or Ethereum could end up being held in these regulated custodial paper vehicles. And if that happens, does it truly benefit the core concept of decentralization? You could have a situation where the asset's price is booming due to ETF inflows, but the underlying network's actual utility or active user base is stagnating or even shrinking. That creates a potentially fragile ecosystem disconnected from its roots.
That's a really sobering thought, a disconnect between the financial asset and the underlying technology's use. And this brings us right to the core conflict, the fundamental tension that our sources really zeroed in on, the shift in power dynamics. On the one hand, institutional acceptance brings undeniable legitimacy, massive inflows, price appreciation, all things that seem bullish. But on the other hand, it inevitably ties crypto much, much closer to the very traditional financial system, the TradFi world, that it was originally designed to disrupt or even replace.
This is the absolute crux of the Web3 dilemma right now. This rapid acceleration of mainstream adoption driven by ETFs comes at a potentially significant cost to the original ethos, the original vision. Remember, the founding promise of Bitcoin and much of crypto that followed was about financial sovereignty. It was about self-custody, that phrase, not your keys, not your coin. It was about eliminating intermediaries, cutting out the banks, the gatekeepers. The whole movement was fundamentally about disintermediation.
Right, peer-to-peer electronic cash controlled by the user.
Exactly. But when BlackRock, Fidelity, and maybe a handful of other giant custodians end up holding millions of Bitcoin, or potentially Ethereum, on behalf of millions of ETF investors, well, the power dynamics inevitably, dramatically, shift back towards those Wall Street gatekeepers. You recreate centralization, just with different players. This concentration of custody risk is also inherently dangerous. What happens if just 3 or 4 major ETF issuers and their chosen custodians end up controlling, say, 80% of the easily accessible Bitcoin or Ethereum supply? That represents a massive centralized point of failure. Or perhaps more realistically, a massive centralized point of control that regulators or governments could potentially target or influence far more easily than a truly decentralized network of individual holders.
And if we look beyond Bitcoin, specifically a proof-of-stake protocols like Ethereum is now, this concentration of custody risk becomes even more critical, doesn't it? Because holding the coins often means controlling the network's governance.
That is perhaps the most alarming potential philosophical consequence, especially for networks like Ethereum, Solana, Cardano, etc. If institutional ETFs become the dominant holders of staked ETH, for instance, they don't just hold the asset, they also control the vast majority of the staked ETH. And in proof-of-stake systems, that staking power often translates directly into validation rights and, crucially, governance power over the network's future. Protocol upgrades, changes to monetary policy, censorship resistance decisions. This could mean that a handful of large, centralized, heavily regulated financial institutions might effectively end up holding the voting majority, the controlling interest, over the future development, stability, and even the censorship resistance of supposedly decentralized public blockchains.
Wow. So the very entities crypto aimed to bypass could end up controlling its future direction via ETF ownership.
It's a profound irony, isn't it? For the early adopters, the cypherpunks, the people focused on that original vision of decentralization and censorship resistance. This tension is incredibly deep. Success, if measured purely by price appreciation driven by institutional adoption, might paradoxically mean losing the philosophical soul of the movement. It could mean replacing decentralized peer-to-peer power with centralized corporate control cloaked in a regulated wrapper.
That's a heavy thought. Okay, so wrapping this all together, what does this complex picture mean for you, the listener, trying to make sense of it all and navigate this landscape? Let's try to summarize the key takeaways from everything we've discussed based on the sources.
Okay, key takeaways. First, if ETFs continue to expand beyond Bitcoin, and especially if they crack open major assets like ETH and potentially SOL, you absolutely must prepare for a few things. One, expect potentially major, maybe even unprecedented liquidity surges and likely significant price appreciation driven by that new wave of institutional money finally having an easy way in. Two, expect, as we discussed, much tighter correlations between crypto prices and traditional financial markets, especially tech stocks. Crypto will likely behave more like the Nasdaq, which diminishes its diversification appeal but signals deeper integration. And three, prepare for continued, perhaps even increased, sharp volatility, specifically around regulatory deadlines, news events, and filing announcements. The market will be hypersensitive to regulatory signals as traders try to front-run those huge institutional flows.
Okay, so big potential upside, tighter TradFi correlation, and regulatory-driven volatility. And what about the ultimate lesson, maybe especially for listeners who are thinking long-term, who care about that sovereignty aspect? What does the rise of ETFs mean for ownership?
Yeah, this is maybe the most important point for the long-term thinker. While these ETFs are undeniably phenomenal financial products, they boost prices, they grant incredibly easy access, they solve custody headaches for many. Their very success highlights the critical, enduring importance of understanding and, for some, holding actual crypto in self-custody. If what you value most is true personal financial sovereignty, the ability to transact peer-to-peer globally without asking permission, the power to exercise ultimate control over your wealth without reliance on any intermediary, Wall Street or otherwise, then self-custody, holding your own keys, remains the gold standard. It's the core principle. ETFs are fantastic bridges to the traditional financial world. They bring crypto into that system, but they are not and cannot be replacements for the financial sovereignty that holding your own keys provides.
A really crucial distinction. ETFs is a bridge, not the destination itself for those prioritizing sovereignty. Well, this has been a fascinating deep dive. We've really explored what feels like a fundamental, almost unavoidable tension playing out right now. The massive, undeniable bullish potential of trillions in institutional liquidity and market validation, running headlong into the very real risks of Wall Street asserting centralized control, or at least profound influence, over what was born as a radically decentralized asset class. It's a conflict, a negotiation really, that seems set to define the next decade of finance.
It really does, and that leads perfectly into the final, maybe provocative thought we wanted to leave you, the listener, with today. Something to really mull over, building directly on that sovereignty versus centralization debate we just had. Here it is. If ETFs do become the dominant, the standard, the default way that most people across the globe gain exposure to crypto, if the vast majority of Bitcoin, Ethereum, and other key assets end up being held passively within these custodial ETF wrappers, how fundamentally does that collective choice hurt or change or maybe even ultimately undermine the decentralization ethos that originally inspired and built this entire space. Does the undeniable convenience, the ease of access, and the likely price appreciation that ETFs bring, does that ultimately justify handing over effective custody and potentially down the line, even network governance power, back to the very same centralized financial institutions that crypto initially sought to bypass or render obsolete?
A really powerful question to ponder, especially as you watch those SEC filing deadlines and ETF flow numbers in the months and years ahead. That is a wrap on today's deep dive into the ETF frenzy, the institutional ramp up, and the soul searching it's forcing on the crypto world. We covered the catalysts, the mechanics, the precedents, the metrics to watch, and those crucial existential trade-offs. We'd love to hear your thoughts on this. Drop us a line. Are ETFs ultimately a net positive for crypto's long-term health and vision, or do they represent a dangerous step towards handing too much systemic power and control back to Wall Street? Let us know your perspective. Thanks for joining us on the Deep Dive.